Hello dear students, welcome to CAT course offered by St. George's College and Vitra. This is paper 1, Fundamentals of Financial Accounting, video session number 4. Today we are going to discuss about the generally accepted accounting principles. So let's see what is generally accepted accounting principles or GAAP. So these are a set of rules or conventions or standards which are established by financial accounting standard boards, and they are known as generally accepted accounting principles. We know in the entire world there are different forms of accounting standards. So there should be a uniformity in recording all the transactions. So to record all the transactions in a uniform way, there are certain set of rules, certain set of conventions and standards, and that is known as generally accepted accounting principles. So this is to be followed by all the accountants while preparing their books of accounts. And for the examination point of view, you should know who has established this generally accepted accounting principles. It is established by Financial Accounting Standard Board, and that board has designed certain set of rules, conventions and standards. And what is the relevance of these generally accepted accounting principles? So it is a combination of standards, and we are using it for recording and reporting the accounting information. So this particular generally accepted accounting principles, it is mainly applied at the time of recording as well as at the time of reporting. So at the time of recording and also at the time of reporting, there should be certain set of standards. So that standards are being derived at generally accepted accounting principles. And we can see that this GAAP is followed by the companies. Why the companies are following these GAAP principles? Because it helps the investors at the time of their investment purposes. So why these rules, procedures, etc. are followed by the companies? It is mainly to help the investors. And what the investors are doing, we know investors are investing in every business, and they should know the profitability, earning capacity of the business. And after analyzing all these things, they are using or they are taking this information for their investment purpose. So these GAAP principles are mainly adopted by the companies to help the investors and to help them for making their investment purposes. So that is all about generally accepted accounting principles. Now next we are going to discuss about accounting concepts and certain conventions. We know while recording the transactions into the books of account, we are taking into consideration certain assumptions. That assumptions are known as concepts or conventions. So before that, let's see which all accounting books of accounts are being prepared by the accountants while preparing their financial statements. So there are 3 basic financial statements, which means accountants are generally preparing 3 basic financial statements. And the first one is known as the profit and loss account. And this profit and loss account is showing the net result of the business. The result means the profit or the loss of the business. And we know what about the balance sheet. Balance sheet gives the financial strength of the business, and it will be on a particular date. The balance sheet is prepared on a particular date, and it shows the financial position or the financial strength of the business as on that particular date. So the basic difference between the P&L account and the balance sheet is P&L account is generally prepared for a particular period to ascertain the financial results, but the balance sheet is prepared for on a particular date, and it shows the financial position or the position of the business or the financial strength of the business on that particular date. And the third statement is the cash flow statement, and this statement shows the movement of the cash, which means the inflows and outflows of cash balances that is being derived under our cash flow statement. So these are the 3 basic financial statements which are being prepared by every accountants. And while preparing these financial statements, we should take into consideration certain concepts as well as certain conventions. Now let's see what are the accounting principles, the meaning of accounting principles. So these are guidelines that provide standards for scientific accounting practices and procedures. So I have already told you that this accounting is mainly used by the accountants, but the accounting system is giving us so much relaxation or freedom to use different types of accounting methods or procedures. So in order to have a detailed analysis, there should be a uniformity. That's why we are having certain principles. So these are basic guidelines. So the accountant should follow these guidelines. And why these guidelines are given? For scientific practices and for following scientific procedures. So that is what meant by the accounting principles. These are guidelines, and it helps us to make accounting practices more scientific, accounting procedures also more scientific. Now today we will be discussing about the overview about the theoretical base of accounting. So here we are having certain assumptions, we are having principles, and we are having certain modifying principles. So while we learn the fundamentals of financial accounting, you should be very much thorough with all these assumptions and all these principles. So in these videos we will be discussing about all these assumptions and principles in very detail. So let's see the first part, that is the basic assumptions. So the basic assumptions, the first one is the business entity concept. So we are very much familiar with the word entity. Entity here means there is a separate existence, that is a distinct existence. So as per this concept, the business is having a separate existence apart from its owners. So the concept says that owner is different and the business is different. So the transactions are to be recorded into the books of accounts in the point of view of the business and not in the point of view of the owners. So even though the owners has contributed this business, they have started this business, but the transactions are only recorded in the point of view of your business and not in the point of view of the owners. Okay, so this transaction or this concept enables to record the transactions in the point of view of the business. So the transactions are to be recorded in the point of view of business. That is known as the business entity concept. Let's move on to the next concept, that is known as the going concern concept. So what is the meaning of going concern? Going concern means the business will carry forward for an indefinite period of time. That is, it is going ahead and there is no intention to close the business in the nearby future, and that is what meant by the going concern concept. So that is what it is given here. It is having an indefinite period, or the business is having an indefinite life, and there is no objective of the business to close down in the immediate future. So if the assumption was not considered, one will have constantly value the worth of your assets and the resources. So if the business is immediately closing down, it says that every year we need to value our assets and our liabilities, and we need to calculate our net worth. But generally the net worth of the business is usually calculated only at the time of winding up. We are not calculating it at the end of every year. Why? Because of the going concern concept, because we have the assumption that the business will carry forward for an indefinite period of time. The going concern concept forms a sound basis for the preparation of the balance sheet. So mainly the balance sheets are prepared at the end of the financial year to know the value of your assets and liabilities, and this balance sheet is being carried forward to the next period, and every year we are assessing the financial performance with the help of balance sheet, and the preparation of balance sheet is due to which concept? The going concern concept. Now we are moving to the third concept, that is known as money measurement concept. So this gives a clear-cut indication to the accountant that the transactions which can be measured in terms of money can only be recorded into the books of account. So that is a criteria. Only those transactions which can be recorded in monetary terms or which can be valued in monetary terms can only be recorded. So the recording, if it is to be done, that always should be made in terms of money, which means non-monetary transactions are not at all recorded into the books of accounts. The advantage of this concept is that different types of transactions could be recorded as homogeneous entries with money as a common denominator. So here we can consider all the transactions, that may be two small transactions like payment of wages or payment of salaries, etc., and very high end transactions like purchase of building, purchase of land. Everything could be recorded, and here we have a homogeneous factor, which means all the transactions at the end of the day will be recorded or will be recorded into the books of account in terms of money. So it gives a guideline that all the transactions should be expressed and should be recorded only in terms of money, and that is what meant by the money measurement concept. Now we move to the next one, that is the accounting period concept. So we know a period means that is a time interval, and every business need to know about the performance, the position of the business, right? So generally in accounting period concept, the life of the business is broken down into a smaller portion, and this smaller portion or the smaller interval is known as the accounting period. So the business entity is to be supposed to pause after a certain time interval. Why this pause is to be made? The pause is to be made to evaluate your performance, which means the profit performance or the loss performance. So the business transactions are to be paused to know the financial result, and that time period, that interval is known as accounting period. So different business units are considering different time periods as their accounting period, like it can be from 1st January to 1st December, or from 1st April to 31st March, etc. So the business can decide which period is to be taken as accounting period. So generally it should be a period covering of 12 months, and there we are making a pause. Why the pause is done? In order to check the performance, and that interval period is known as the accounting period. And there is a guideline. In India, all the listed companies should report their quarterly unaudited financial results and yearly audited financial results. So that is a mandate in India regarding the listed companies. They should provide us quarterly unaudited financial results and yearly audited financial statements. So that is to check the performance, to check the to evaluate the performance of the business. So the business is also considered as a living organism or a continuous organism. So it is a living being, and it continues for a longer period. That's why the entire life, the longer life of the business is cut down or shortened down to a smaller time interval, and that smaller time interval is known as accounting period. And we move to the next concept, and that is the concept name is accrual concept. So in accrual concept, it is regarded as we are recording the transactions which are both in cash nature as well as in credit nature into the books of account, and that is known as the accrual concept. So the accrual concept, when it is introduced, it is giving us the right that the transactions which are both in terms of cash, or the buying and selling both in terms of cash as well as not in terms of cash, which means credit, those transactions both can be recorded into the books of account to analyze the profit or the loss. In case of cash transaction, the owner's equity is instantly affected as the cash is either received or paid. So if it's a cash transaction, we know either it is received or it is paid. So which means it automatically will affect what? The owner's equity. It will either increase the owner's equity or it will decrease the owner's equity. But what happens to the credit transaction? It is just an obligation, which means in future the amount will be paid. and that type of incomes are known as accrual income or accrual of the revenue, which means that are postponed and the amount only will be received in a future period. So today's accounting system based on the accrual concept is known as the accrual system or the mercantile system. So the accrual concept is also known as the mercantile system of accounting. So these are the basic things that we have discussed today. So we have discussed about the basic assumptions related to our accounting. So three concepts we have discussed today. That is, the first one is generally accepted accounting principles, and the second one the basic assumptions, and the third one regarding the accounting principles. Thank you for watching the video.